So yeah, we had to put everything just on hold over $75.
Yeah.
Right? Like that's wild. So somebody making, $300,000-$400,000 misses a payment of $75, clearly could have made that payment. Money's not the issue. And all of a sudden, here we are 6 months later, and we're finally just in a position now where everything's fine. His credit score's back up. I think they disputed it with the credit bureaus, whatever. His credit score's finally back, getting back up to where it was. He's in the sevens again. And but it took a long time to get back there, right? So credit's huge.
Welcome to the Rains Report with your host, Jason Rains.
What is going on, everybody? We are back with another edition of the Rains Report. Again, on all your podcast channels, just search Rains Report, and then we drop those on Friday, and then on Saturday we release the video files of them on YouTube. So whether you're watching on YouTube or you're listening on podcast, make sure to hit that subscribe and notifications so you get everything, guys. We have a guest in here today. It's not Luke for a change. Thank God. I know you guys are ready for a break from him. We actually got Dalton in here today. So everybody say hi to Dalton. Dalton, why don't you tell him who you are and where you're from, man?
Yeah. So I was just, my car broke down. I was walking around the highway and Jason picked me up. So now here we are. But no, my name's Dalton O'Donnell, Lee Summit, Missouri. Been here for 20 plus years. I am a local lender, Total Quality Lending, but I run a team called the Odo Home Loans team. And we just care about helping people, getting them those homes, helping them build their credit, and just help them build wealth.
Yeah.
Yeah.
Yeah. Awesome. So we thought that this would be a good podcast today to kind of talk about credit, right? And how important credit is when it comes to buying a house. Like, I don't know about you, I'm in a million Facebook groups, right? And you always see people posting, oh, I need a house for rent, or somebody will be like, oh, why don't you just go buy a house? And, it goes back and forth, and, oh, I don't have any credit, or I don't have any money put down. Or I saw one yesterday and the house was like $75,000, like in a rural area. Probably would have qualified for a USDA loan, I'm guessing, which is 0% down, right? And I know some lenders that don't like doing loans that small, right? Because at the end of the day, like, the company still has to make money.
Yep.
But this girl's like, well, I don't have 20% to put down. And I was like,
that's crazy.
20% on? No, like 3 to 5%, maybe 0% down, right? But that's getting it off a little bit what we're going to talk about. But so credit scores, like, are they important? Like, what do they need to be? Like, what should people even be paying attention? Like,
yeah,
I don't know. I try to stay in my lane, which is not the finance lane, right? So I know a little bit, but yeah, why don't you tell, what can you share about the importance of credit scores?
Yeah. So, and just to give a little backdrop too, I look at a lot of credit reports. I mean, thousands of credit reports in what I do now, but I've looked at even thousands before that. I used to be a financial advisor. And although we didn't do loans there, I got a good grasp of financing and building wealth and credit. But I also ran a used car dealership that focused on subprime credit. Mm-hmm. So we got a lot of people with bumps in the past on their credit score. And you look at a lot of credit reports that are there. And you kind of figure out a little bit of loopholes and, what ruins people's credit and what helps. So that's just a little background of what I know. It's more so off experience, not because I'm a certified credit repair guy or anything, just experience. But just like what you were saying with the 20% down, I say that's probably one of the most common myths in lending. Would you agree?
It's a lot of people think on a conventional loan, and depending on the house, maybe it, for whatever reason, maybe it only qualifies for a cash or conventional loan if it's, if there's a bunch of safety issues or wood rot or something where it wouldn't go FHA or VA, right? Yeah. That only leaves cash and conventional. And then, a lot of times people are like, oh, yeah, I need 20% down on this house. Yep. Which, that's great if you have 20% down, right? But you definitely don't need it. Yeah. And sometimes it might be smarter not to put the 20% down and maybe do something else with those, the difference in those funds, right? Yeah. So, but definitely definitely a huge misconception.
And we can go down that rabbit hole later if
Yeah.
you want. But,
okay. We'll see if we have time for it.
yeah. But that same myth is very common. I mean, there's a almost equal myth with credit, right? A lot of people think, oh, I need a 680, 700, 720. Like, I know in lending, you do get a little bit bump in rate if you're a 740 or above.
Yeah.
But really, there's programs out there that can do as little as 500 or 550.
Yeah.
Now, you can't walk in with zero down and get a loan for that credit score. They're going to want a better debt to income ratio. They're going to want more down. Like we have one that's 550 and above for FHA or VA, but you need at least 10% down.
Yep.
Right. And then, of course, the house has to meet the guidelines.
So it all kind of just plays together, right? Like you can have a lower credit score if you have a lower debt to income ratio or more money down, or it just kind of like, you just kind of piece it together based on the individual, right?
Yeah.
But yeah, you definitely don't need a 700 or 750 or an 800 credit score.
Exactly.
Just to go out and buy a house, right? And I think that a lot of people have that misconception, and it keeps them from even reaching out to somebody like me or somebody like you, and even exploring the options, right? 100%. Like I know when somebody reached out to me, I'm like, hey, like let's just have you call a local lender and see what they say. Just run some different scenarios. Who knows? Like you might be surprised and figure out you can go, buy a house, or we can find you a house or whatever. So, I know we were talking a little bit before this, and I started kind of telling the story, and then I was like, oh, I'm gonna hold off and tell this one while we're talking. But I had a client, a younger guy, but makes really, really good money, right? So I've been working with him for probably, I don't know, since the summer. So like of 22. So we're talking like, at least I've been working with him for at least 6 months now. Right. And, we get working. He has a pre-approval letter for a pretty good house, like pretty substantial house. Like I said, super young, making a lot of money. First time homeowner, but he's like really like 22 years old. Right. So with that, he had started kind of building his credit and had a good credit score. It was in the mid sevens, which is that's good. Right. And, he, missed a payment on a credit card, right? Didn't even know about the credit card. The credit card was all paid off, and there's an enrollment fee, like annual enrollment fee or something. And he didn't catch it because he doesn't use the card. He just has the card. And then it was like $25, right? But then they tacked on a $25 late fee, and then they tacked on another $25 late fee. And then they reported it to the credit bureaus, right? And so literally in the matter of, 3 months, his credit score went from a 7 something, I don't know, mid sevens, dropped him 200 points into the mid fives, right? Over $75 when he's making multiple six figures. It's not like he's at 100,000 and a dollar, right? Which if he was, it's $75 is nothing.
Yeah.
He's making like 2-3 times that amount.
Yeah.
And literally, like, we had to put it on hold because he couldn't get a loan because he was in the mid fives making good money, but like he's making good money, but didn't have all the money yet. Like he just started that job and is paying really well. So he didn't have a lot of that money in yet. There was no credit score. Like there was no credit history, if you will. Right. And, a couple of his other things were pretty high. So his debt to income ratio was still pretty high, even though he's going to make good money. He hadn't really started bringing that money in yet. So it was the promise of the money that was going to be made, right? You know what I mean?
Yeah.
So yeah, we had to put everything just on hold over $75.
Yeah.
Right? Like that's wild. So somebody making, $300,000-$400,000 misses a payment of $75, clearly could have made that payment. Money's not the issue. And all of a sudden, here we are 6 months later, and we're finally just in a position now where everything's fine. His credit score's back up. I think they disputed it with the credit bureaus, whatever. His credit score's finally back, getting back up to where it was. He's in the sevens again. And but it took a long time to get back there, right? So credit's huge.
Yeah, and that hits home because that happened to me.
Yeah, okay.
I switched bank accounts. So my ACH, I added the new bank account, but it was like subordinated to the first one.
Yep.
And for whatever reason, they didn't go down the line and run the second one.
Yeah.
And it was a $25 payment. It was like a TJ Maxx credit card.
Wow.
And 100 points, like overnight, as soon as I hit
Man.
that 30-day.
Yeah.
And, you know, time will heal, right? Time
Yeah.
will heal that. But credit card payments are the number one just murderer of credit.
Wow.
It will affect your credit. You can skip a car loan. I won't, not home loan, but credit cards will destroy your credit score, and just like that.
Yeah, I
It
never
can
knew
be a
that.
$500 balance. When
Yeah.
you have a $10,000 balance on a car loan, you miss
Yeah.
one car loan. It's not going to hurt your credit as much as missing one credit card loan.
Okay. So what you're saying is skip the car loan before you skip your credit card payment.
Skip no loans. But if you
Yeah.
are in a tough position, like in all seriousness, call the bank, call the credit union, let them know what's going on. Say, I don't want to miss my payment. I don't want it to hurt my credit. Like, can you work with me? Can you defer this next payment? Can you give me a 2-3 month, deferment? Like, they will work with you if you communicate with them. So
Yeah.
that's huge. A lot of people don't know, especially like credit unions, local banks.
Yeah.
Like, if you got a credit card or a car loan, even a home loan with them, like, just talk to them.
Nice.
When you ghost them and you don't make a payment, then they're gonna put on your credit.
Yeah, see, I wouldn't have thought about that either. But I
Yeah.
think that I think a lot of people are like, oh my gosh, I can't believe I'm in this position. Like, I didn't think this would happen. Like, maybe they're embarrassed or maybe they're scared.
Yeah.
And they're just like, I'm just gonna push this off to the side and hopefully
They forget it or they miss it. They
and
forget about it.
hopefully nobody says anything, but they don't realize is the ramifications that has, right? Versus just, like I said, picking up the phone and calling them.
And you make all the
saying,
money in
"Hey,
the world, you
yeah.
have no debt, but the payment history is going to hurt you more. You could be
Yeah.
making $1 million a year, but you got a 550,
Yeah.
like you're not going to get a loan.
Yeah.
Hopefully you buy cash at that point.
Yeah. I mean, yeah, it's just crazy.
Yeah.
I mean, I've had other clients in similar positions as him and where their credit was fine and they could have put more down and they still chose, I mean, they probably could have paid cash, right?
Yeah.
For a $500,000-$600,000 house. They could have paid cash if they had to. In that position, what you're talking about, that's really the only option.
Yeah.
Now they didn't because they wanted to keep their cash and
Right.
just
Leverage the bank's money.
use the bank's money and just put 20% down in that position. They were fine to put 20% down, right? So, I mean, kind of looking at that, what is the advantage of somebody putting 20% down versus 10% down? Like, what do they gain by putting more money down?
Yeah.
Maybe you can explain that to like buyers out there.
Yeah, and if you didn't listen to his other episode where he kind of went into that and talked about, saving the $16 a month with 20% down rather than, I think it was 15% down,
Yeah.
that example.
Yeah.
So two things. One, when you put 20% down, you don't have any PMI if it's a conventional loan. However, if you put a little less than 20% down, you actually get a little bit better of a rate most of the time.
Okay.
So yes, you have PMI, but if it's helping with the interest rate, like in your guys' situation, he probably got a lower rate. And then the difference was and it could have been a little bit more in PMI,
Yeah.
but the actual difference to not put 5% down was the $16
Yeah.
a month, right?
Yeah.
So,
And on a $240,000 loan, 5% is $12,000, right?
Yeah.
So he kept $12,000 in his pocket. I think that's right. I did the math really quick on that, right? 10%, 240, 10% is 24,000, half that's 12,000, right?
Yeah.
So he kept 12,000 in his pocket and has to pay an extra $16 per month. I would much rather have 12,000 in my pocket
yeah.
and pay $16 extra a month. You can do a lot more with the 12,000
Yeah.
than you can with the $16,
100%.
right?
Yeah.
So, but that kind of falls back to communicating with the lender and saying, hey, let's run some different scenarios here, right? Like I can put 20% down and say the PMI, but is that the best option for me? Like, give me some numbers here. Like,
And if there's this, also, if you put less than 20% down and you make less than the median average for the area of where you're buying, which I believe in like Lease Summit, for example, is $75,000. So if you make less than that and you're putting less than 20% down, you get what's called like affordable pricing.
okay.
So it's Fannie Mae, Freddie Mac, Home Possible, Home Ready is the programs they call it. And especially if you're a first-time home buyer, they're just going to give you better pricing and better rates. So,
Okay.
so yeah, in that situation, you got a first time home buyer or not, but it makes sense to look at 20% down and maybe a little bit less and see what that difference really
how
looks
that
like.
how that changes, right?
Yeah.
Yeah.
'Cause I'd like to
Interesting.
have an extra 12 grand if I bought a house, especially a used house, to maybe do some remodeling or there were some repairs they missed,
Right.
you know, because I got a good deal on it. I want some cash to,
Or maybe you just want to go invest the money.
yeah, or maybe, you know, go to the
Right.
casino.
Yeah,
Yeah.
may go bet on the Chiefs beating the Bengals.
Put all on
right?
red,
I mean,
red
hey,
Chiefs.
Hey, that's right, right? Yes, I mean, don't go spend your 12,000 on betting, please.
No, this
but
is not financial advice.
yeah, definitely not financial advice.
Yeah.
But no, there's just so many different options out there. It's easy to see why people who aren't in this industry, right? And I mean, heck, sometimes all this finance stuff confuses me because again, it's not my lane, right?
Yeah.
But that's why you have somebody that you can call and say, hey, like this is the situation. What do I do, or what can you do, or what is it? And that's me, and I'm in quote unquote the industry, right?
Yeah.
Somebody that's just out there, especially a first time home buyer,
No, I ain't.
like
I don't know any of this.
they don't know anything,
Yeah.
right? Like this would be completely overwhelming, or probably is completely overwhelming to a lot of people. And maybe not even for the first time home buyer, but what if they haven't bought in 5 or 10 or 15 years? Like I'm sure quite a bit's changed in the last decade when it comes to different options that are out there.
Mm-hmm. Well, and they also, if it's been over 3 years, they qualify for it first time. As long as they have been on title for 3 years,
Mm-hmm.
they can qualify for the first time home buyer programs.
Okay. So explain that. So if they haven't, let's say I bought a house 10 years ago,
Mhm.
but I'm on the deed like the whole time, I wouldn't qualify for that?
Yeah, you have to
Okay.
be off a deed for the last 3 years.
Okay. So what would be a scenario where maybe somebody would be off a deed for 3 years?
They just sold their house and then rented, you know, but they've owned in the
Okay.
past.
Okay.
Yeah, they've been
What
previous owners.
about, let's say my wife and I, we buy a house, right? And we're both on the title from the beginning. And let's say we're thinking ahead, right?
Mhm.
Like
Yeah.
we're playing the long game here. And we're like, man, we're going to go, I think we're only going to be in this house like 4 more years,
Mhm.
right? Could I do a quit claim deed over to her, taking my name off
Mhm.
the deed to the house? So now it's just her name on the house. Fast forward 4 years, we sell our house, we go buy another one, and we just put this one in my name. Would that work? I mean, I don't know. I'm just like, I just came up with that, right?
Yeah, no, I've been asked this before. The only issue there is you also got to prove your residence history where you've lived.
Okay.
So if you're on an application with your like spouse, they own the house, it's in their name, you're not on it, but you have shown that as your residence history on the credit application, well, they're going to be like, okay, well, you know, show me they might not ask for rental history, but like how much were you paying in rent?
Okay.
So like it gets a little gray there. Yeah.
I mean, I love the gray.
Yeah. I mean,
So-
some, you know, some lenders will just play dumb and send it up and see if it hits or not.
Yeah.
But yeah, that part's a little gray.
Yeah. I mean, could you just pay the wife?
Yeah, she could pay him rent. I mean,
can
could have
I
some-
pay her rent for 3 years while we're running this through, waiting? playing the
yeah,
long
just
game?
say, hey, this is, you know, we have a unique
I
relationship.
pay her rent, and then
We're
she
married.
uses that rent to pay the mortgage.
Yeah.
I mean, I'm just saying, you know
Yeah.
what I mean? Like,
As long as you have a good, like, it makes sense logically with the underwriters and you have a story to go with it, then really
I mean, just be
there's
careful.
a chance.
Be careful because
You
once
can't
you
guarantee.
quit claim deed that house over,
Yeah.
and then I mean, technically you're off the deed. If she leaves you, you're kind of SOL at that point, right?
Yeah.
Like,
Yeah.
well, you're not because
Yeah.
state of Missouri is
No fault.
marriage assets. What is it like?
Okay.
It doesn't matter if you're on the deed or not. Like
Yeah.
if you're married,
not a
it's
community
mutual.
property.
It's mutual assets, right?
Mm-hmm.
So you wouldn't have to worry about them leaving you in that situation in Missouri
Yeah.
because you would still be.
I think they call it community property. in
Yeah,
state.
yeah, you'd still be due whatever the judge determined your part of
Yeah.
the assets
Yeah.
were in the house. So, yeah. I'm trying to think what else you see come up when people start like getting like with down payment and credit score? Like, what are some other problems you see that people need to be aware of?
Yeah. So back to credit. One thing that I'm seeing a lot of right now are people that need a little help with credit. Most lenders have the ability to run a wayfinder, is what our software is called. It's essentially a simulation, but you say, okay, my score is at 580, sorry, and I want to get it up to 680. What do I need to do? It will run the simulation. It'll tell you exactly what you need to do, and it won't guarantee it. It'll say there's a 95% chance that it will go up to this, and it'll tell you exactly what to do. So if you are having some bumps in the road, still try to get pre-approved and say, well, can we run a wayfinder, or is there anything that you would recommend for me to build my credit? What I typically do is I start with the wayfinder, see if there's an easy path there. If not, then I help them with, like, it's typically collections, right?
Okay.
So a couple things there. Personally, I've had low credit. At one point in my life, I had a 550, I had a few medical collections, a couple other collections, and I would call them and I would negotiate, and I'd say, hey, I know I owe you $1,000. I got $500. I'll pay it right now if you just wipe it clean. And they're like, oh, I can't do that. I'll do it for $700. Well, I just saved $300, right?
Yeah.
Rinse and repeat. That adds up.
Yep.
But what I just recently learned, and here, let me take one more step back. Doing that method with negotiating will build your credit, but not all the time. With me, it boosted me like 40, 50 points.
Okay.
Right? But what will for sure build it is when you do that same thing, but you say, I'll pay it right now if you delete it off my record, or you delete it off my credit and send me a deletion letter.
Okay.
So it being deleted altogether will take it off completely, so creditors can't see it, versus just negotiating. It will have a little disclaimer that says paid for in less than full, or something along those lines.
Yeah.
So that was something I just learned recently. So if you are in a situation where you got some collections and you can call, pay less, but use as leverage for yourself, say, hey, I will pay it if you delete off my record and send me a
And who deletes it, the
letter.
creditor or the credit bureau?
The creditor will send, I don't know how they do it, but they'll tell the bureau, hey, this was a mistake, or
take it off, right?
Yeah. So that is something that can really quickly boost your score. Yeah.
What do you see? Like, I know I had a client one time. So scenario was credit issues, right?
Mm-hmm.
Some late payments. They actually had some that got, I think it was called like charged off or something like that.
Yeah.
Right. And we're like, the credit card company's like, nope, like we're done. Like, we're just going to forward this on to basically, can you explain a charge off? Like, I'm not very good at it.
So charge off is they're writing that debt off. They're not pursuing to collect it anymore. It's going to stay on your credit, but you don't have to calculate it in your debt to income.
Okay. But how does it affect your credit? Can that be pretty harmful?
Yeah, it can. I mean, it's just showing that you didn't fulfill your promise of paying a debt, but the debtor, the collector, or whoever's got it, is not pursuing to collect it anymore.
So in the client that I was dealing with, we actually ended up being okay, because they had actually, even though it got charged off, they went ahead and sent the full amount due to, it was a credit card, right? We're talking about cards. They were like, hey, I actually have it, right? I didn't then, or whatever the situation was. I try not to get involved in people's finances. I'm like, hey, if you can afford the house, like that's all I need to know, right? Like, let's move forward, right? But whatever you and the lender need to talk about, like, that's none of my business, right? And I tell them that all the time. I'm like, hey, your finances are not my business as long as you're approved to buy a home. Like,
I can do my job.
I don't need to know all the details about your past, right? But this one, they told me a little bit, like, that's what happened, and then they paid off the full amount, right? And I think it still showed on their credit, but it showed like a pay in full or something like that, or it was satisfied, but it still showed as a charge off.
Yeah.
So there was a little hiccup, but like, there were still some questions on, like, I don't know, it still doesn't look great.
Yeah.
But it also says it was paid off, so you did fulfill your obligation, but it's still on the credit report too, right?
That's where you say, hey, I'll send you this money.
Yeah.
But I need you to delete it.
And I don't think they did that.
Yeah.
Right. So then, like, once you paid them, what's their, do they have an obligation to go ahead and remove it? Or two, they're like, hell, we got our money. Who gives a crap? Like we're good. Like we're not gonna spend our time doing that. You've already paid us.
Yeah, it's
Right.
going to take a lot of energy and time to get them to end up getting that off
Yeah.
because there's nothing they can do to benefit from that. It's only you.
Yeah.
You know?
And how long does stuff like that stay on somebody's credit?
So typically 7 years. Yeah.
7 years.
Yeah.
Yeah. Like late payments and those charge offs or everything or just
Yeah.
yeah.
That's a good. Most of them are all going to be 7 years.
Yeah. So if you miss one credit card payment,
Yeah. 7 years.
that stays on your credit report for over half a decade.
Yeah. And I was able, so there are some like tips and tricks or tricks of the trade to get some of that off. Like if you did miss something and you don't want to wait those 7 years, like for example, I was talking to a credit expert the other day. He's not a credit repair guy. He's a credit expert. And he said, credit repair companies, you pay them a monthly fee. They send letters on your behalf to help you build up your credit over time. He's more like, I'm going to tell you exactly what to do, exactly what to say, but you have to do it.
Okay.
So he had a guy, made great money. He was a doctor, 2 Amexes. He sent in $10,000 to one to pay it. And the other one didn't get paid. It wrote him late charge, right?
Yeah.
But he told them, he's like, look, I've never missed a payment. I make good money. You really think I would send $10,000 to pay one card? No, I wanted it to go to both. You guys screwed up. You made a mistake.
Yeah.
And there might have been some other legal word like CFPB. You know, they probably quoted some legal jargon to help them show that they know what they're talking about. But he coached them exactly what to say, and they removed it. And he never saw it and was able to buy a home. So there are some. I'm not there yet. You know, like I said, I'm just going off my experience. I'm not an expert. But I know some people that know all the loopholes there.
So I mean, you say you're not an expert, but you know enough. But you also know, hey, if this is a situation where I don't quite know everything, you know people that do though, and you can send them to those people. Like, I don't know all the ins and outs about lending, but I know loan officers that I can send people to get those answers, those questions answered. And then if there's more questions that you can answer, you can connect them with somebody else. And it's really just about the team that you have in place, right? And having multiple people that are able to answer questions. Like there might be a loan that you can't do that someone else might be able to do, right? I mean, there's so many different things out there, right? So let's say someone, okay, we've kind of got past that, and they maybe have some credit issues, and we've got past that, right? Would you say what's the difference? And I'm asking this, like, I know this, but I'm asking like more for the average home buyer out there. What is the difference between or the benefit of going with certain this loan company versus this loan company, like A versus B type thing, right? Is there a big difference in rates? Is there a big difference in fees? Is there what's the advantage of using one company over another company? Because a buyer might be like, hell, I don't know. I'm just going to call Rocket Mortgage. Like I see their commercials all the time, right? Like, I don't know. Like that's the only one I've heard of.
Yep.
Don't do that, by the way. But anyway, go ahead.
Schmortgage. So I always tell people, especially when they're buying, like go with a local lender, somebody that focuses on purchases, because you can still have a local lender that is kind of a refi shop where their sense of urgency isn't going to be as the same as the seller of the home and the buyer of the home and the realtor, right? Because closing on time, I mean, you are risking the buyer's money. They could lose the house and lose their earnest money if you don't close on time. So that is huge, right? When it comes to rates, like I like to say all the water comes from the same well, but there's going to be a little bit of fluff. Some places their margins can be a little bit higher. They have more overhead, more, corporate executives to pay. Banks, like Bank of America, they have a lot to pay, but they keep their loans in-house. So sometimes you get a better rate. However, you might not be closing for 60, 75 days because they're all W-2 salaried. They get off at work at 5 every day. Someone like myself and like you, we work around the clock, right? We're 100% commission, and we don't get paid unless your home closes. So on purchases, I always say, go with the local lenders, especially somebody that's not just an hourly employee, because they're going to work extra hard for you to make sure you close so you don't lose your earnest money and you don't lose that house.
Yeah. I mean, Bank of America, for example, I had a client a couple of years ago. That's what they wanted to use. They're like, no, that's where we bank. I'm like, I don't suggest it, but again, I can't make you not to use them. I mean, we got the house under contract, so the seller was fine with it. And yeah, we got in and we started hitting roadblock after roadblock after roadblock, and it was a remodel, and it was another realtor who had remodeled the home, and they were wanting like specific documentation on what he had paid, like what he had bought the house for.
Oh wow.
And then asking for receipts of work done to show like the markup.
Mm-hmm.
And he was like, this is insane. I've never been asked for this from any lender ever on any of the remodels I've ever done. This is bullcrap. I'm not going to give you that information. Like, it has no bearing on this deal. And like Bank of America was like literally holding this up. And finally my client was like, dude, you got anybody we can switch to? Yeah. And we still closed late, but it was only like a few days late versus it was going to be a few weeks late.
Yeah. And
their house was under contract. Like we already had their house under contract. Like, it all snowballs, right? Yeah. So, yeah. So you talked about like the fluff or whatever. So like today, or we'll say yesterday, I won't put you on the spot for a day. What were, because you might not have checked because you're driving here. Yeah. What were rates yesterday, approximately?
So yesterday, I quoted a lady that they were putting, let's see, it was a conventional loan, roughly 275, putting 20% down, and her rate was about like 6% was par.
Okay.
But it so here's a cool thing that, and I always give people options, right?
Yep.
So with this same lady, I sent her 3 different options with and without like par, but there was like, because we're set up with US Bank as an investor.
Okay.
So we can get US Bank rates, but you still go through a local lender to close on time and hustle for everybody. But they had like, their pricing was basically they would have had to pay up to get that 6% with US Bank, or they could have paid a quarter of a point and got 5.625.
Okay.
So sometimes they have sweet spots.
Yeah.
So also going with a lender or broker that, and I can go into the details of the differences there if you want me to, but somebody that has options that to look at different investors or different lenders to kind of get you the best rate. Like for example, so our company, Flat Branch Home Loans, like there's a lot of like local lenders that can do both, right? They can broker and shop. They could keep it in-house. They can outsource it, like US Bank, stuff like that. So there's a way to look at all the options and say, hey, you pay a little bit more, we get you a like way better rate.
Yeah.
So that's like brokers on the other hand, they don't keep the money, they don't fund the money, they don't have in-house underwriters. They could shop you like I can, but they just lose a little bit of control. Sometimes they have a little bit more room to play with on margins, but you lose a little bit of the control.
So on that 6% deal, for example, right? Oh, I got 2 things.
Yeah, I went down a rabbit hole. You got me going.
No, you're good. So 6%. Could there have been another lender out there that could have also got them 6%, but then said, you know what, like, I need to make a little extra money this month. At 6.1 is the best I can do. Like, can lenders do that?
Yeah, they can. Now it's illegal.
Okay.
Unless you have
they shouldn't do it.
They shouldn't do it. Yeah, you cannot charge and you have to treat everybody the same.
Yeah.
Right? Doesn't matter how much money they make, where they're buying. Like that's illegal. You can't do that. But do they do it? Well, I've seen it happen.
Yeah.
There are loopholes in the system, and it all comes down to your marketing plan, which is it's not like traditional marketing, what you think. It's more of like a pricing plan. Like, okay, we charge X amount if it came from this lead source, or it came from this lead source, or this lead source.
So you're treating everyone the same within that lead source.
Yeah, like where they came from, right?
Yeah.
So, but even then, it's like what I do at the end of the day, I treat everybody the same.
Yeah.
Because I don't want to play around in that. Do what's best for the customer, give them the best rate, best foot forward. Because I've also seen lenders where they'll say, oh, this is your rate. And then they'll say, hey, Dalton, can you give me a better rate? I'll get them a better rate. And then they'll go back to their lender, and then their lender just magically drops the rate more. I'm like,
Yeah.
well, like,
Yeah.
how'd you do that?
Right.
You know?
Shouldn't you have been able to do that from the get-go?
But it
versus,
happens all the time.
Later on. Yeah.
Yeah.
Interesting. So
I think as long as like they're not going to get in trouble, as long as they're really just not taking advantage of people.
Yeah.
They're within they're not
a small amount. Yeah. Yeah. Interesting. And now I already lost the other thing I was going to say. So we're just going to skip on that. So,
but yes, credit. One more thing I want to add about that. So a quick way, especially if you're younger, or you don't have any credit history at all, if you have a family member or a friend or a mentor, they can add you as an authorized user on your credit card. Two things happen. Well, maybe three. So you get a trade line, right? You're getting the length of that trade line. So if you are 18 years old, and this must just be a loophole because it doesn't make sense logically, but say you're 18 years old and somebody with a 10-year Amex with perfect payment history adds you as an authorized user. Well, now the computer can't recognize the two differences. So now you have that 8 or 10 years of credit history.
Wow.
It's
okay. So question.
But now their credit score, they have a good credit score.
Yeah.
And now I don't really have to do much.
Our son's 14 years old.
Yeah.
Okay. I don't know how long we've had our credit card. I have no idea.
Yeah.
A long time, right? I probably at least this credit card we've probably had at least 14 years would be my guess, right? So if let's say I call my credit card company up, right? He has no credit. He's 14 years old.
Yeah.
He's never, I mean, he pays for stuff, but like, cash, obviously, right? He doesn't have any other way to pay for it. So he has no credit score. He has no debt. He has no income. Well, different story.
Yeah.
But if let's say I added him to my credit card, right? And I said, hey, I want to add my son to my credit card. Here's his social security number. Here's his date of birth. Here's his name. Send the card, right? They're going to add him to the account. They're going to send him a card. I'm going to take that card and go put it in my safe. He's not going to touch that credit card, right? He has it. Yeah. I'm not even going to tell him he has it. It's just going to go in the safe. It can sit over here. I don't want him using that thing. Does that start building a credit history for him because he's on that account at that point and start building up that score?
Once he's 18, yes.
Okay. So you have to be 18.
Yeah. Yep.
Okay.
I can't do it now. But yes, when he's 18, that will do that. And that is the quickest, best way. If you have children, add them as an authorized user. Don't give them a card, right?
Yeah.
Don't even use their email or their phone number.
Yeah.
Because there's a way to, forgot password and get in there and request a card.
I mean, by 18, they're going off to college. They might get a credit card at that point anyway.
Yeah.
But man, just with all the problems that we've just talked about, I mean, he probably will have one because he needs one if he's in college and he wants to be a pilot. So that's something you kind of got to go to college for that.
Yeah.
Man, that's really risky to have a credit card out there and, somebody who's not used to or doesn't understand the impact that can have, right?
Mm-hmm.
That's interesting. You say you have to be 18. I didn't know that because literally right now, I could pay him up to $12,500 a year.
Yeah.
That he does not have to. My business. Sorry, I'm not paying him.
Yes.
My business is paying him. My business could pay him $12,500 a year this year. I think it's going to like $14,000 in 2023 or 2024. Yeah, I know it's going up.
Yeah, I know it's going up. I just don't know how much.
But in 2022, it was $12,500. Your company, if you have a company, can pay your child as an employee. Mm-hmm. You get to write that money off from your bottom line, and they don't have to pay taxes on it.
Yeah, I know.
So you could literally pay now you have to, I'm sure, be able to show what they did if you got audited, right?
Well, they're a model. They're a model for your business. You put them in some pictures and videos, marketing.
I'm taking a bunch of meat rubs to a convention in Las Vegas later this month to hand out as because Kansas City's barbecue, right?
Yeah.
We did a podcast on barbecue.
Yeah.
So I'm taking a bunch of meat rub. My son literally last night he filled 200 bottles, 205-ounce bottles of meat rub, right?
That's awesome.
I could pay him to do that, right?
Yeah. He
wouldn't have to report that up to $12,500. Now, if you're really smart, you're not even telling him you're paying him. You're just putting it into an account. So it sits there, right? I mean, we could go on and on about
maybe a
this, but
tax-free.
yeah. So I thought like, oh, if I can do that, I can go and add them on the credit card now, and it can start building that. I didn't
think
realize
so.
you had to be 18 for that.
Yeah.
So yeah,
Yeah,
learning.
just to
I'm
get a
learning
loan.
here.
Yeah, to get a loan, you have to be 18 to sign a contract. You have to be 18 to join the military.
Yeah,
But
yeah.
you can get paid, tax free
Yeah,
from a business, which is
Interesting.
at the age of, I think, as soon as they're born, really, because they could literally be a model, like put some of your swag on them,
yeah,
do some videos and photos, and now, hey, you're paying them for marketing.
yeah. So definitely, there's definitely ways to save money and invest money and really set them up so that when they do go to buy a house in the future, then they're in a better position.
Yep.
At least do the credit card thing and don't give it to them.
Yeah. You don't even have to request a plastic. Like,
Yeah.
you can add them as an authorized user where they don't get a piece of plastic.
Even better. Yeah.
Just don't even have it at the safe.
Yeah. Right.
Limit that chance.
Yeah.
Yeah.
So yeah, I mean, I think we've covered a pretty good range of really just
We made
a lot of stuff, right? But definitely when it comes to the whole credit issue, which I think it's just it's a little scary to people, right? Especially if they start getting behind on stuff and it's affecting their credit score. And just know that there's ways. You don't have to have a perfect credit score. There are ways to get it up. There are different avenues to go down and still have options to buy a home, even if you're in that position. So yeah. So I think hopefully that was helpful for everybody today. And I think we're gonna call that a wrap. But it was great having you on today, and appreciate the insight, because I definitely learned stuff. So if I'm in the industry and I learn stuff, hopefully our audience learns stuff as well. So
yeah, and I'm more than welcome to answer any questions of anybody that watches this.
Drop them in the YouTube comments. Drop them on. I think you can comment on podcast, right? Yeah, you can
put in the review.
You can drop comments in there.
Put in
too,
your 5-star review that you're leaving.
Right. Drop it in there, and we can always circle back around. And make sure you're hitting that subscribe and the notification bell on the podcast or on YouTube. And until the next video, guys, have a great day.
The Rains Report is brought to you weekly by Juke Media. Look for episodes every Friday wherever you download podcasts. And remember to rate and subscribe for more content.